So, what are the economic effects of a new museum, a new stadium, the expansion of a zoo, the building of a new store, or the development of a new airport? What are the contributions to the local economy from a university, a research and development center, a bookstore, a local attraction, a new mass transit system, or a library? The term economic impact analysis refers to surveys, research, and modeling to estimate the direct and indirect economic effects of an entity or event on the local country, state, or U.S. economy as measured by employment, tax revenue, income, or gross product. The impact of an economic event is the summation of direct effects and indirect effects. For example, when millions are invested in building a new convention center, that money, i.e. the stimulus, flows through the local economy multiple times as construction supplies are purchased, as the construction workers spend their paychecks at local supermarkets, restaurants, and other retailers, who in turn buy more inventory, and so on and so on. That is, an initial stimulus triggers a chain of spending. The chain of spending is estimated via multipliers. Multipliers are derived from input-output analysis of an economic system. Input-output analyses measures how all of the major variables in an economic system interact. One industry's outputs are, in turn, inputs in other industries and vice versa. Input-output analyses measure all the linkages and flows within the economy. Based on these linkages and flows, the cumulative effects of any given stimulus or change can be derived. This is the basis of our discussion today. As discussed last week, there are several trends in sport facility management and construction. Essentially, three facets of government and sport teams are financially interrelated: the subsidizing of construction, the subsidizing of infrastructure, and the subsidizing of operations. From our previous discussion, we know that sport teams and leagues have much to offer local communities. So that begs the question, why would taxpayers be against subsidizing sports? Well, believe it or not, many have no interest in sports. Many have objected to using scarce government funds, cash, to provide entertainment, and many cities are in trouble financially. There's been strong objection and opposition to using government funds to subsidize wealthy franchise owners, and there's questionable economic benefits or returns from employment and increased potential wealth that did not materialize. Our previous discussion centered around increased community visibility, enhanced community image, stimulation of other development, and psychic income. However, beyond the largely intangible aspects of psychic income, image, and visibility is the economic impact of a sport team or a league. As mentioned previously, the economic impact is the net economic change in a host community resulting from spending attributed to a sport facility or event. Essentially, there's two types of analyses here: the economic impact analysis, which looks at new money in minus the cost, which equal the gross economic impact, or the economic benefit analysis, which is new money in equaling the economic benefit. For the purpose of today's lecture, we're going to focus on the economic impact analysis and the advantageous aspect of new money in providing direct economic impact to local communities. While there are many reasons to support an economic impact analysis, the literature and your textbook generally refer to four: new construction jobs, new spending generated in the community by attendees and workers, the team attracting tourists and companies, which thereby increases local spending, and number four, the multiplier effect, is income causes spending and job creation. Many advocates tend to argue that new stadiums spur so much economic growth they are self-financing. Essentially, the subsidies are offset by the revenues. Is this true? Well, this is one of the questions we're going to seek to answer today. Some of the pro-investment arguments, or folks that are in favor of the economic impact of new stadiums and facilities, say that economic growth spurs the self-financing, ticket and sales taxes offset other taxation used to finance the facility, and property tax increases due to the facility adds income to the local government. Sport events are among the largest economic impactors to local economies and governments, and there's several sporting events which contribute to this idea. The top 10 economic impact sporting events are auto racing, generally regarded as the top 8 or 7, depending on which list you look at. For example, the Indy 500, the Daytona 500, and the Brickyard 400. Rounding out the list are the Super Bowl, Kentucky Derby, U.S. Open. To answer the question, what do all these events have in common? Generally, these events are spanned over multiple days. In the case of NASCAR or the Daytona 500, for example, it is usually regarded as 2 weeks provided before the event. Thus, the most efficient way to increase the economic impact of the event is the length of stay for the individual. The alleged rationale or flow of money for economic impact is as follows. The residents essentially pay taxes, which is the seed money that the residents provide in terms of tax revenue, general sales tax, and property taxes. This revenue then subsidizes the sport facility or arena, which in turn attracts visitors who then spend their money at the event or the arena. This money is alleged to create income and jobs in the area, and the inflow of revenues goes directly back to the residents. It is often argued, however, that without public funding resources or public sector resources to offset the staggering costs, then the economic benefits to the community will never accrue. So today, we're going to focus on how much the residents will receive in return for their initial investment, beyond just the large intangible aspects of psychic income, visibility, and image. Before moving forward and understanding the various details of economic impact analyses, there's several key questions we must ask and then answer. First, why is the study being done? Essentially, it's to assess the economic benefits to the local community. Who wants to study? Sport organizations and community officials, or the smaller, homogeneous groups that tend to drive the funding source. The point here is not to find the truth, but rather justify something the supporting group is trying to prove. Why do they want to study? They want to convince the taxpayers of the wisdom of the subsidy, with some legitimate accounting firms with solid reputations to provide validity for the findings. Essentially, that is the who is conducting the study. In the case of the San Francisco Giants, they wanted to leave for San Jose several years ago. The budget director documented that a $3.1 million net gain was seen in San Francisco from the team. The caveat here is that San Francisco's gross economic product is only $30 million. Essentially, if the Giants did leave the city, the money would be deflected towards other recreational expenditures, essentially the $3.1 million that they were touting. San Jose city officials, on the other hand, because they wanted to publicly fund a brand new stadium for the Giants, stated that the economic impact gain would be between $50 and $150 million annually for the team. That begs the question is, why is there such a large discrepancy? Well, the people hired to do the analysis are compared to expert witnesses. The San Jose example was $3.1 million versus approximately $150 million. Again, it's to justify the expenditure, not to find the truth. Regarding the actual economic impact analysis, there's several principles that cannot be violated in order for the study to be sound and valid. These are the 5 principles that govern the integrity of the economic impact study. The first of which is exclusion of local residents, meaning you should exclude local residents in the economic impact analysis for it to be valid. The primary premise behind the economic impact study is that new money is injected into the economy. So, why would you not want to measure local resident spending? Well, that's recycled money. That's money that's already in the community and could be deflected elsewhere rather than at the sport facility or the event. Visitors include media, vendors, sponsors, external government entities, and other investors, and those who only come specifically for the event should be counted. Again, local resident spending is not calculated because it's recycled money. If it wasn't spent on the event, it would be spent some other place. When local spending is omitted, the numbers become small and politically useless. That's why local residents are oftentimes counted in the economic impact analysis. Consider, for example, the Green Bay Packers. All of their games is dominated by local spending, small, publicly owned team. Thus, if local residents were discounted from the economic impact analysis, the numbers would be too small to justify anything brand new. Researchers and city officials who are measuring the economic impact of an event must also exclude time switchers and casuals. Time switchers are non-local spectators at an event that may have been planning to visit the community but change the timing of the visit to coincide with an event. Essentially, the spending would have occurred without the change, although it would have been at a different time of year. Casuals are visitors who are already in the community, attracted by other features such as beaches, restaurants, bars, or cultural activities, who elected to go to a sporting event instead of doing something else. For example, if you're visiting a friend in Tampa and decided to go to a Yankees game, the beaches might have attracted you there and your friend might have attracted you there, but you decided to go to a game on a whim. There are several financial metrics used to gauge the actual economic impact of an event, facility, or something else. The 2 of the most popular are income and sales output measures. Income refers to the money that's directly injected back to the local economy as income to the residents. Sales output measures measure the sales that accrue from that event. The flawed part of this example is that most of the time, researchers use income rather than sales. These income measures are grouped into 3 specific categories: direct, indirect, and induced. Direct is the first round of spending, such as buying tickets, spending money on hotels, or food in restaurants. The second level is indirect spending. This is the ripple effect of the spending. This is where the supply chains and hotels spend their money back to the electric company to keep the lights on and to stock their resources. The third level, induced spending, is the further ripple effect generated by the first two rounds. This is how the employees of that electric company spend their money on entertainment in the local community. Geography also plays a role here. For example, zip codes, the city, the county, and state boundaries, and how large an area is oftentimes determines which measure will be used. The use of sales measures are impractical. They do not offer insights that are useful in guiding policy decisions. The fourth principle is using multiplier coefficients rather than actual multipliers. First, we need to talk about the multiplier concept. This is when visitors spend money in the community and their direct expenditures stimulate economic activity and create additional business turnover, i.e., multiplying the cash. Multipliers translate a known or assumed direct effect into an estimated total impact, equal to the direct effect plus an indirect effect. Here's how it works. First, there's an initial injection of money from non-resident spending in the community. Again, the non-resident part is the key here. This money is spent in 5 basic ways. Number 1, with local businesses to restock. Number 2, as salaries for residents within the community, direct household income. Number 3, local government in terms of sales tax, property taxes, etc. Number 4, non-local government taxes. And number 5, employees, shareholders, businesses, organizations, and others residing outside of the local jurisdiction. Just to reiterate, the multiplier effect is visitor spending at a sporting event, the operative word there being the visitor. Approximately 90 to 95% of all United States counties multiplier should fall between 0.4 and 0.8. This is obviously depending on the size of the city. And this means essentially that for every $100 of spending, the local residents or local community officials can expect approximately $40 to $80 in return. The upper end of the multiplier is often used if it's a more urban area, and the lower end if it's a more rural area. For example, New York City might have a multiplier of 0.8, whereas Gainesville, Florida might have a multiplier of 0.4. The multiplier is oftentimes the most abused part of the economic impact study because of the subjective nature of the size of an area. Most of the time, the metropolitan statistical area is not taken into account, and it's usually a subjective measure of how big they think the area is. 3 types of multipliers are sales and transaction multipliers, and this depends on the revenue from increased sales of goods and services. An income multiplier, and this is how extra spending influences household incomes in a host community. And the employment multiplier. This reflects full-time jobs that are supported by the initial and ripple effects of spending in the community. First, I'm going to provide you with an illustration of how the sales multiplier works. Imagine there's an external visitor injection of $100 to the local community. Allegedly, the direct income created is $25. The secondary impact, which is the indirect plus the induced money, approximately $20. Therefore, the total income created based on that event or the facility is approximately $45. We derive the coefficient by adding 25 and 20, which gives us a multiplier coefficient or a sales multiplier of 1.8. Therefore, for every $100 injected into the economy of a city by visitors, an additional $80 of personal income accrues, using sales as a multiplier. These monies can be seen in the form of employee wages and salaries and proprietary income, for example, private ownership businesses. Conversely, the income multiplier relates to the direct and total income generated, not to the initial change created by visitor spending. And here's how it works. Again, the external and visitor injection is $100, followed by the direct income created, which is $25. Again, the secondary, indirect, plus induced effect is $20, which gives you $45 again, same as the previous example. However, the coefficient derived by 25 plus 20 divided by 100 now gives you a 0.45. Obviously, the recommended coefficients are between 0.4 and 0.8, so this falls in line with that idea. Therefore, for every $100 of personal income that accrues in the city, i.e. injected funds by visitors, an additional $45 of personal income will be created. And fifth, and probably what you'll decide is the most shocking principle that's violated by economic impact researchers, is their interpretation of employment measures. We must carefully interpret these when in fact they are not usually carefully interpreted. These measure the direct, indirect, and induced effect of an extra unit of visitor spending on employment in the host community. For example, it's alleged that for every direct visitor expenditure, an additional number of jobs will be created. The rationale is that for every $100 injected in the community, a 0.52 jobs will be created. So for every $100, basically 1/2 of job is created. There was a Baltimore Ravens example several years ago when the team moved to their new location. An economic study stated that 1,700 jobs will be created based on the money that's generated from the team. In actuality, NFL teams only produce about 71 full-time positions, including the players on the roster. Thus, the hours worked times 52 weeks would have been 65,000 hours per year. The violation here is that most of the jobs are seasonal. NFL teams play on average 8 to 9 to 10 home games depending on the playoffs. Therefore, 65,000 hours is just not a feasible number. The problems here is that it estimates both full and part-time jobs, and no distinction is made between the two. Second, researchers assume that all existing employments are fully occupied, meaning every job is taken in the city. An increase in visitor spending will result in an increased level of employment, which is simply not true. All new jobs will be filled by local residents, which is again not true. Oftentimes companies like Aramark or other large manufacturing and beverage companies hire people from outside of the local area to run their operations. Some of the problems associated with the economic impact analysis are that they are largely hypothetical, they are based on estimates, they're also based on certain conditions and very lofty assumptions, as you may well know, and it's largely an inexact process. Some other problems are that the wrong multiplier is used. Most of the time the income multiplier is used rather than the sales. Many spectators are local residents, and time switchers and casuals oftentimes are the norm. What are some additional problems you can see from the team and fan level? Well, the athletes on the teams are alleged to make so much money that they provide an increased tax base or tax rate back to the local city. This is largely not true. Most of the athletes don't actually live in the city in which they play. They live in the outside areas, or in the case of Philadelphia, where I'm from, they live in New Jersey to avoid city tax wages. The teams don't spend most of their time at home. In fact, for Major League Baseball, they spend half of their time on the road. Same with the NFL. They're not at or around the stadium at all times. Sport teams are generally small, and they contribute no more to the economic economy than many other firms. Teams are large to medium-sized firms. They're not economic engines. They have too few employees and too few direct dollars to stimulate economies in the way that most researchers argue. The pro sports sector is a small portion of the region's economy. Usually less than 1% of all jobs can be accounted for by a sport team. The transfer of money maintains that not new money associated with spending is used. Additional studies show that approximately 4/5 of spending would have occurred without the sporting event. Think about it. If you're not going to go to an event and you want to go do something, you're going to spend your money in another way. Last, the majority of revenues collected pays the players. Most save and spend their money in their home communities, and more than half of that money will never go back to the local economy. So what's the difference between a cost-benefit analysis and an economic impact study? Recall that an economic impact is the net economic change in a host community resulting from spending attributed to the sport facility or event. Conversely, a cost-benefit analysis is specifically designed to identify the return on investment made in sport facilities. Economic impact is more of an esoteric figure, whereas the cost-benefit analysis weighs the actual cost versus the actual benefits that do materialize. There are several costs that are associated with the economic impact analysis that need to be considered as well. Number one is what we call impact costs, and this is the cost of additional labor and equipment and supplies, essentially extra demands on the community. Along the line of impact costs come the social costs, such as traffic, accidents, congestion, and additional garbage. 2, displacement costs. Oftentimes, large-scale events or new facilities or arenas displace local residents, oftentimes leading to large traffic and congestion and less spending by visitors. Displacement of other visitors wanting to come to the community, but don't do so because of the crowds. And also, all are regarded as economic impactors, but they simply displace others who would have been there as well. For example, when a new arena is constructed downtown, they have to replace or relocate the locals that were living there previously. Property taxes can go up because of the new arena, so on and so forth. And third is opportunity cost. Remember, this is what you give up to build something else. So could you build a sport facility or a convention center which could potentially be active year-round versus a sport facility which is very seasonal? Remember, the facility provides entertainment for locals and some visitors, but the convention center could attract non-local residents and bring in more outside money. This is why Las Vegas is such a successful enterprise. In summary, economic impact is the economic net money spent by visitors to a local community. Should not include money spent by residents, and geographic information can provide a hearty justification for locals versus non-locals. Time switchers and casuals should not be included, and money is divided into 3 specific elements: direct, indirect, and induced. There's 3 multipliers that are used, often which are the most abused part of the economic impact analysis. Several costs need to be considered as well, for example, impact, displacement, and opportunity costs, and the money is spent in 5 different ways, and there are also several leakages to describe. The recommended multiplier coefficient is between 4 and 0.8, and there are several other aspects of the economic impact analysis that need to be considered as well. Given the equivocal findings and the large methodological debates that surround most economic impact analyses, researchers and government officials have been looking for alternatives to measure such benefits that do materialize or accrue. One of those alternatives is referred to as the contingent valuation method. The contingent valuation method, or CVM, has been utilized as a means of modeling proposed or existing environmental and other service enhancement programs, for example, sport, recreation, and other publicly sponsored programs. The CVM has been employed in various contexts, such as the description of water quality, state park expansion, protection of natural resources, and most recently by sport researchers to identify consumer preferences toward team relocation and new facility construction. The CVM involves directly asking people in a survey how much they would be willing to pay for a specific service. In some cases, people are often asked for the amount of compensation they'd be willing to accept, which is regarded as WTA, or willingness to accept, to give up a specific environmental service, or the amount they are willing to pay for them. The CVM is a direct method that involves asking a sample of the relevant population questions about whether they are willing to pay for a new environmental or social service, or whether they're willing to accept compensation for a social or service that's going to be removed from the community. It is called contingent valuation because people are asked to state their willingness to pay contingent on a specific hypothetical scenario and description of the service. There are several advantages and disadvantages to this method. The advantages: number 1, it can deal with both use and non-use values in a community. Use values are values derived from actual uses of goods and services. Uses may include indirect uses, for example, going to a professional game. These may have been captured by attendance figures and TV ratings. Non-use values, on the other hand, are values that are not associated with actual use, or even the option to use the good or service. Sometimes they're simply referred to as existence values. Use the Florida example to illustrate. For example, if you live in the state of Florida and you reside in Gainesville, the use value would be the Florida Gators football stadium. The non-use values would be the beaches in Jacksonville, the ability to go to Orlando and use the theme parks, travel to Tampa to see some spring training games, etc. Just because you don't use them doesn't mean you can't derive utility from them. Alternatively, the disadvantages are hypothetical bias, which is not an indicator of actual consumer responses, which we'll talk about in a second, and scope sensitivity. A scope test looks at whether respondents are willing to pay more for a good that is larger in scope or either equal in quantity or quantity sense. There are several steps to conducting the economic impact study, and in addition, there are also several steps to conducting the contingent valuation method survey. Basically, in CVM research, respondents are chosen by some statistically valid method and are asked to play the part of a market participant in a hypothetical scenario. The respondents are asked to answer questions as to what actions they might undertake in the hypothetical circumstances presented by the researcher, and they might be asked to explain those actions as well. So 1, creating a survey instrument for the elicitation of individuals in WTP or WTAC. You have to design the hypothetical scenario, decide whether to ask about WTP or WTAC, create a scenario as a means of payment for compensation. And number 2, use the survey instrument with a sample of the population of interest. Again, the sample must be appropriate. Third, the researcher will analyze the responses to the survey in 2 main ways. First, they'll use the sample data for WTP or WTAC to estimate the average willingness to pay or willingness to accept compensation for the overall population. Second, they'll assess the survey results so as to judge the accuracy of their WTP or WTAC estimates. Next, they'll compute a total WTP or WTAC for the population of interest use in a cost-benefit analysis. And fifth, they'll conduct a sensitivity analysis. The CVM has also been referred to as a revealed preference method, which looks at hedonic prices that can be only estimated as use values, so only if that value affects behavior in a measurable and interpretable manner. Hedonic prices, as a caveat, the basic premise of this pricing method is that the price of a marketed good is relative to its characteristics or the services it provides. For example, the price of a car reflects the characteristics of that car: transportation, comfort, style, luxury, fuel economy, etc. Therefore, we can only value the individual characteristics of a car or other good by looking at how the price people are willing to pay for it changes when the characteristics also change. For the rest, we have to use either hypothetical markets or experimental markets. This is a stated preference method. Continued valuation method is referred to as stated preference because it asks people to directly state their values rather than inferring values from actual choices, as the revealed preference methods do. For example, the economic impact study is a revealed preference method. The fact that CV is based on what people say they would do as opposed to what they are observed to do is the source of its greatest strengths and also its greatest weaknesses. In an example, the authors of this study employed the use of a CVM to address the public's willingness to pay taxes in keeping the hockey team, in this case the Pittsburgh Penguins, from relocating to another city. They found that 40% of the sample supported public funding of the new stadium, and surprisingly, the same proportion of individuals voted for the sales tax referendum to allow for stadium construction. So in an ideal situation in a CVM, you have a hypothetical scenario, but then again, there is an actual change in the community. For example, the Penguins were a credible threat of leaving the city. This is an important consideration with regard to the CVM because the study has to show that there is a posed critical threat to alleviate what we refer to as hypothetical bias. Conversely, when examining the CVM of a hockey team, almost 70% of respondents felt the Penguins generated some form of civic pride for the community, so the tangible and the intangible. In this study, the interviewer introduced themselves, provided the background of the survey, so the opinion about the tax allocation, the measures to build a new arena. Next, they ask about the value of the team and the stadium to the community. They describe the construction scenario if the team was going to depart the city. If no action was taken, how likely is it that team would leave? They describe all possible scenarios, and they ask how much would you be willing to pay. They also record the socioeconomic characteristics of each individual. Oftentimes, the hardest part of the CVM study is defining the market scenario, essentially asking the person what is being valued. Is it a day at the ballpark, a view of the ballpark? Is it traffic congestion from the stadium, trash, etc.? Therefore, a policy intervention or change may be necessary. These do have plausible and comprehensible outcomes. And again, what is the payment vehicle? Is it a tax, an entrance fee, a levy on parking? And note that people will have various and divergent responses to these actions. The researcher must also choose an elicitation method, or the method of asking the questions. For example, is it a direct question? How much are you willing to pay? Is it a bidding game? Are you willing to pay X? If yes, X plus D. If no, X minus D. Is it a payment card? Choose from a list of numbers, including comparisons, just a list of various payment methods or money extracted from the community? Or is it a referendum of choice? Are you willing to pay X? How about for a different X? And how many people will be asked? Note here, we are looking for the maximum amount of WTP or the minimum amount of WTAC. There are several methods to administer the CVM approach. You can do it by mail, telephone, or in person. With regards to mail, there's no feedback or additional clarification is not possible. With telephone, it has to be simple and short. No graphical material is able to be presented to the respondent. In person is obviously the best, but it's expensive and there's interviewer bias embedded within the results. Are the people approached a representative sample? And those who answered, does the survey itself induce bias? For example, in knowledge, does a person actually have knowledge of the situation under experimentation? One of the largest inhibitors to the interpretation of the contingent valuation study is its validity. Validity is, does the study measure what it's intended to measure? And there are several types of validity that need to be considered with regard to the CVM. First is the content validity or face validity. Does what is measured and what is supposed to be measured coincide with the actual referendum? Second, criterion validity. Do the measured values correspond to other measurements of the same thing? Third, construct or convergent validity. Do the measured values correlate to measurement of similar things? And third, construct or theoretical validity. Do the measurement constructs correspond to certain predictions that the researcher has made about the responses? Reliability means, is the study replicable, or can we produce the same results over time? This is the second most important consideration to a CVM study. Can the study variable be used multiple times in achieving the same result? The more familiar people are with the good and the scale, the more reliable the measured values are. For public goods, referenda and taxes are perhaps the best. For quasi-private goods, individual questions and entrance fees may be a better interpretation. Again, the payment vehicle may distort the actual measures. There are also potential biases that can inhibit the reliability of the study. First, is it the incentive? Is it strategic, or is it a compliance measure? Is there an implied value? Is there a starting point? A range? Is it relational? How important is it to the individual? And the position of the individual also needs to be considered. Also, and finally, misspecification. Is it theoretical? Is it amenity? Or is it a context measure that is largely an esoteric idea of what the individual might respond to?